What will happen with inflation? That's the topic of the day. And in this video, I'm going to show you how understanding the past can help you predict the future, giving you greater financial freedom and, maybe even more importantly, greater personal freedom. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the view from my good buddy, Jeff Snider. We're going to talk about the 1940s inflation and the 1970s. We're going to look at Jeff Snider's view, and then in step number 2, we're going to go over the view of my other very good friend, Lyn Alden. I think that Lyn and Jeff are the top macro thinkers in the business today. But let's start by going over how Jeff looks at the 1940s and the 1970s. To do this, we're going to go over a very extensive chart that he used in a recent blog post. Editor, let's go right to the internet. And like I said, this chart is very detailed. It gives us the CPI year over year, interest rates on the long bond, the 5-year, 10-year, and 3-month T-bill. So let's focus on the CPI and the long-term Treasury bond. So this shaded gray area and the black dotted line. We start off at the beginning of the 1940s. This was World War II. And as Jeff points out, we had an extreme supply shock, very similar to what we had in 2020 and 2021 with the cerveza sickness. So this created an environment where CPI went through the roof, up over 8% and potentially even higher, but then it crashed back down. So what was happening at that time with the long bond? Well, yes, we did have yield curve control, but you'll notice what's very interesting is that the interest rates actually went lower than the cap that was announced or explicitly announced by the Federal Reserve. So this would tell us that there was actually more demand for these bonds than was even being supplied by the Federal Reserve. So theoretically, you could say that right here in 1946, even if the Fed would not have been buying bonds or would not have had this explicit target objective of yield curve control, that interest rates might not have been any higher. But what happened in 1947? We see that the CPI, as measured by the government, went way up to almost 18, 19%, potentially in 1947, and then once again came crashing down. Now, this was due to what Jeff calls a post-war supply shock. And I would point out between 1949 and 1950 that inflation was actually negative. 2%, 3%. So prices were going down, not just going up at a slower rate. And then we had the Korean supply shock in the 1950s. And then what happened is once yield curve control was ended, now whether or not that made a difference, who knows? I think Jeff would argue that it really didn't make any difference whatsoever. But then we started to see interest rates creep up. With the 1950s, they gradually continued to go up until what we saw in the 1970s, where they peak out around 79 or 80. So Jeff's argument is that prior to the 1950s, what we saw in the 1940s really wasn't inflation, because he's defining that by an increase in the money supply. We know that Milton Friedman is famous for saying that inflation is always and everywhere a monetary phenomenon. If you not only consider the dollars on the balance sheet of the non-bank entities, but also the dollars that are on the bank's balance sheet, Jeff would argue that during the 1940s, you really didn't see a big expansion of the money supply. Therefore, these price increases, not necessarily inflation, but price increases were strictly a result of these supply shocks. And what the yield curve was telling us is, number one, there isn't really an increase in the overall supply of dollars, but number two, that these price increases are only temporary because, once again, they're a result of a supply shock and not an expansion of the overall dollar supply. Then in the 1950s, Jeff changes his view. We can see that interest rates start to go up, as indicated by this black dotted line, and there's more of a trend
where we've got higher highs and higher lows. And this was the bond market telling us that, hey, now there is inflation. Now there is an expansion of the amount of dollars in the system. Therefore, these price increases will most likely be sustained, not just for years to come, but decades to come. So Jeff's main point is in the 1940s, the bond market was actually telling us that there wasn't an increase in the overall money supply or dollar supply, as I like to say. And therefore, those quick bursts of consumer price inflation didn't necessarily imply that the price inflation was going to be sustained over the long term. And maybe more importantly, it didn't necessarily imply that we were going to see much higher interest rates in decades to come. But then in the 1950s, the bond market starts telling us that we are seeing an inflation of the dollar supply. Therefore, the consumer price inflation that we've seen will most likely be persistent, not just for years with these short spikes like we saw in the 1940s, but for decades to come. Remember, this was the 1950s, so the bond market was starting to predict the consumer price inflation and the higher interest rates, very important point, that we would see in the 60s and in the 1970s.
Step number 2. We just went over how Jeff Snider sees the 1940s and the 1970s. But now let's take a look at how Lyn Alden looks at the 1940s more specifically to determine where they agree and where they disagree so you can make better financial decisions for your future. Let's start by going over a chart going back to the 1940s all the way to 1960, and we go from negative 5% up to 20%. This is the CPI as measured by the government. I always like to insert that disclaimer because usually the CPI number isn't really accurate, especially in the 1990s and the 2000s, the 2010s, and what we're seeing today. But let's just go off this chart for right now. In the 1940s, it dips down. Obviously, we're the tail end of the Great Depression. Then it goes way up with that supply shock that Snider talked about during World War II. And it comes back down, just really plummets down almost to zero, then goes way up in 1947, almost to 19%. And then it comes crashing back down to a number below zero. We actually had deflation here, where prices were like -2, -3%. Then going into the 1950s, it spikes one more time, then goes back down. It's pretty much the same chart that Jeff was using, but a lot less detail. But Lyn points out that, okay, there might not have been significant monetary inflation, but prices for the average Joe and Jane really went up. So what are we really trying to determine? Are we just really getting hyper-focused on an increase in dollars? Or are we trying to predict or determine how it affected the pocketbook of the average Joe and Jane? She goes further, points out this chart. And this is pretty much the same timeline, but on the left, we go from 12.5 up to 27.5. And this is just an index of the price increases we saw throughout the 1940s and beyond. So Lyn emphasizes that between the timeline of 1940 and 1952, although we might not have had a huge increase in dollars, prices still went up by 90%. And then Jeff would most likely counter and say, yes, Lyn, you are correct. But let's throw up a chart of interest rates, long-term cycles in interest rates. And look what happened in World War I. They peaked out, they went all the way down and kept going down this trend of lower and lower interest rates. And it bottoms out in 1946, then gradually starts to go up. But then throughout the 1950s and the 1960s, then interest rates were on an upcycle that peaked out in, let's say, 1979 or 1980. So although prices might have been going up and down and up and down, they were extremely volatile, they didn't really tell us a lot about what was going to happen with future rates of interest. So who is right and who is wrong? Like I said earlier, both of these two individuals, in my opinion, are the smartest people that we have in macro today. But they see things a little different. So who's right, who's wrong? I'm going to cop out and say they're both right. And here's why I give you that answer. It all depends who your audience is. See, Lynn is really talking to the average Joe, where Jeff is really talking not to the average Joe, but his more sophisticated cousin. And I should have drawn them up here, shouldn't I? But he's talking to the seasoned pro. So Lynn focuses on prices, where Jeff focuses on the quantity of money or dollars. Lynn focuses on the totals. What is happening with the prices in totality, where Jeff really focuses on the trends, what's going to be happening in the future. And then more specifically for the average Joe, Lynn likes to focus on if you own bonds long term. What's going to happen to the purchasing power of that bond? Or if you're holding dollars, or if you're holding gold and Bitcoin. Where for the seasoned pro, they're going to be more interested, not just in bonds, but where are rates going? Because if I own a bond, they don't really care about the yield from that bond. They want to know if the price is going up or down. Where the average Joe, they're going to hold on to that bond till maturity, let's just assume. So they are more concerned with their purchasing power, not the price appreciation or depreciation in the interim. The average Joe really concerned about the dollars they have in their checking account, where the seasoned pro is far more concerned about the dollar on the DXY relative to a basket of other currencies and the Eurodollar system. What is the global economy doing? And then the average Joe concerned with the price of gold, Bitcoin, the seasoned pro more concerned with what's going to happen with swap rates, Eurodollar futures, in other words, derivatives. So what are some of the main conclusions that can be drawn for you, the viewer, watching this video that will help you make better financial decisions for your future? Number one, we're most likely going into the 1940s, not the 1970s. We could be going into the 1950s, this transition period when we're going from a down cycle in interest rates to an up cycle in interest rates and far more sustained inflation, secular inflation, if you will. But that really depends, in my opinion, on how fast we go to a central bank digital currency. That's really the catalyst to this transition from going from an environment like the 1940s to an environment like the 1970s. But that's a topic for a completely separate video. Next, we'll most likely have a lot of volatility with inflation. It doesn't go straight up. We look at the 1940s and it's up. It comes crashing down. It goes way back up and comes crashing down. And in the 2020s, I think these highs and lows are going to be dependent on how much government spending or deficit spending is being monetized by the Fed. Because this, I think, is the main driver of how many dollars are actually circulating, chasing goods and services in the real economy and creating those economic distortions that lead to supply shortages and supply shocks like we saw in the 1940s and 2020 and 2021. Also, most likely to have low rates longer. I'm not saying that rates don't go up to maybe 3 or 4%, but the probability of them going to 10, 15, 18% like we saw in the 1970s, very, very low. So are bonds a good investment? Well, this really depends on who you are, the average Joe or the seasoned pro. The average Joe, absolutely not, because you're holding those to maturity. And even if this inflation that we're getting is transitory, you're still losing a massive amount of purchasing power. But if you're a seasoned pro and you own those bonds on leverage and you're just basically trading them, all you care about is where the interest rate's going to be in 3 months. You could care less about where it's going to be in 10 or 20 or 30 years. So that's a completely different question. And that's what we have to understand when we're looking at these two views. But for most of you watching this video, absolutely not. Bonds would be a terrible investment because even if the interest rates go down, you're still going to be losing a massive amount of purchasing power to consumer price inflation, even if we are in the 1940s instead of the 1970s. Now let's look at stocks and the housing market. Well, if we look at the 1940s, stocks actually crashed up. It's a term that I use all the time. I wouldn't say crash, but they went up in nominal terms, but actually went down in real terms when you adjust for the rates of inflation. So I think the probability is very high that we see the same phenomenon in the 2020s, that nominally stocks might go up, but it doesn't necessarily increase your purchasing power. Same thing with housing. And then I think the bond market is telling us, rightfully so, that you're not going to see hyperinflation in the United States or with the dollar in the next 2 or 3 years. Most likely kind of in this range between maybe 100 and 85 on the DXY. And again, that isn't necessarily a measurement of the dollar against goods and services, just a measurement of the dollar against other fiat currencies. So what I want to emphasize there is the dollar might be a very good investment for the seasoned pro, but a very bad investment for the average Joe, especially if the average Joe's expenses are denominated in dollars. Step number 3, the bond market is predicting a bear market in economic activity, but also in your personal freedom and liberty. In the first 2 steps, we really outlined Jeff Snider and Lynn Alden's thoughts around inflation in the 1940s and the 1970s, how they differ slightly and how they're catering to a different demographic. In fact, on that note, I've got the average Joe now up on the whiteboard. And more importantly, I've got his cousin, the seasoned pro. That is right. The seasoned pro has his top hat. And of course, he has a fleece vest, because quite literally every trader on the planet Earth has to have a fleece vest. And he's got his piece of shark art, which every single hedge fund manager seems to have. Hashtag Stevie Cohen. Okay, back on to the topic at hand. So let's start by looking at the 10-year Treasury yield, going back to 2017 all the way to 2021. On the left, we go from 0.5% interest up to 3%. 2017, a little over 2.5%. It goes up, peaks out in 2018, and then it really drops down significantly. If my memory serves me correctly, around 2019, the yield curve actually inverted, which is a huge sign of recession. Was this predicting the cerveza sickness? I don't know. I'll let you be the judge, but we definitely had that recession in 2020. Bond yields went down even further, close to about 0.5%, and then they've come back up slightly, indicating we have had, I don't want to call it an economic recovery, but we have had an increase in economic activity, therefore inflation, but now it's really leveled off and it's starting to go down. So is this telling us that economic activity is going to decline over the next 6 months or year? And just to make sure we're all on the same page, for this step, let's look at inflation through the lens of economic output or economic activity. This is very consistent with Jeff Snider's view that we went over in step number 2. I'm going to explain this more in just a moment. But now let's look at what has happened to the price of gold. 2020 all the way to today's date. And it starts right in the middle of this. I kind of ran out of room here. So right in the middle, we've got about $1,800 as far as the price of gold. 2019, it was right around 1,400, 1,500. It goes up to a point here, I think it got over 2,000, but then it's come crashing down and it's really plateaued in 2021. So what is this, the gold price, telling us about future inflation? If we are looking at future inflation through the lens of economic output or economic activity. And then I would ask the same question here about the bond market. And then I would also go back and illustrate what we talked about earlier, that we had an inverted yield curve that preceded the recession for the cerveza sickness. For more insights on exactly kind of what I'm talking about, to connect the dots, let's go right to the internet and check out a recent blog post from Jeff Snider.
In this blog post from December 1st, Jeff points out that the euro-dollar futures curve has also just inverted. And this is a predictor very much like the bond market yield curve inversion that we saw in 2019 and that we've seen several times throughout past decades that have predicted a recession. Or again, let's use the term economic output or activity declining. So Jeff says, what do we mean by inversion? Money, like yield curves, are supposed to be upward sloping, higher interest rates into the future. This is the bias towards growth and inflation, economic growth to be clear, that a generally healthy economic, financial, monetary system produces, one where risks are tilted toward higher rates. So see, what he's doing here is he's saying usually in economic growth or higher rates of economic growth, that's where you see inflation. Therefore, if the yield curve or the gold market is telling us that we will see lower rates of consumer price inflation in the future, this implies that we will also see lower rates of economic activity, or that the consumer prices could be a result of lower economic activity or economic output. He says higher rates, unlike what you've probably been taught, is a good thing. And this is a perfect example of it. In the case of post-2008 world, this is or should be doubly true given that rates are unnaturally low. Not because of Fed, but because of what interest rate fallacy tells us about what the Fed doesn't do, money. And that in and of itself is a completely separate video. But let's just shelf that for right now and go with because rates are unnaturally low. Then he goes on to say the euro-dollar futures curve should be more than upward sloping, especially steep should the market perceive a realistic pathway toward economic, financial, monetary normalcy. Up is good. Higher, more normal interest rates would indicate realistic, more than imagined, recovery potential. So again, now what we're talking about is an economic recovery, a solid economic recovery that is sustainable. And this doesn't have to do specifically with prices, because in my opinion, you can have higher prices while economic activity is actually going down. But to get our heads around this concept and put all the pieces of the puzzle together so you can determine how this may affect your financial future or maybe your future of personal freedom and liberty, let's go back to the whiteboard.
Now let's go back to the chart we used in step number 2, but I've made some adjustments. So back in step number 2, this chart started in 1940, went all the way to 1960. But now I want to imagine as if this chart goes from 2020 all the way to 2040. So the numbers on the left, we'll just assume they're the same. And the first difference here is that I put a black dotted line for the 10-year Treasury yield. And this blue line is exactly what we had throughout the 1940s, except it stops right here. And this is what I envision the future may look like. Actually, this whole chart is kind of a thought experiment of what I'm envisioning the future in the 2020s might look like. So it starts off with this big inflation spike, consumer price inflation, because of the government's response to the cerveza sickness in 2020 and 2021. We know that the CPI has gone all the way up to mid 6%, and that's as measured by the government. So real rates of consumer price inflation would be much higher. But now what the bond market and the gold market could be telling us is that we're going to have less economic activity. So therefore, this inflation rate could come down. Now, it all depends because it could be sustained at very high levels. It all depends on what we have for supply shocks. So if the government comes in and distorts the economy to the degree in which they distorted the economy in 2020 and 21, then we could see this environment where, although we do have demand going down predicted by the bond market and the gold market, the supply of stuff goes down even further. Therefore, prices continue to increase. But let's assume for a moment that the bond market and the gold market is saying, no. What we're going to get is something that looks like the 1940s. So we saw this big price spike in 2020 and 21. Therefore, maybe we'll see the same thing happen where we see inflation go down. Now, I don't think it would go down below zero, but maybe it goes back down to, let's say, 2 or 3%. Why would it do this? Potentially because of lockdowns. Look at what is happening right now in Australia, where they are literally putting people in quarantine camps. Not just people who have the cerveza sickness, but anyone that has been within close contact of them. They're going into more lockdowns throughout Europe. So I think the bond market could be saying, yes, prepare for lower economic activity in the future, which would be something that would pertain to your portfolio. But it also could be saying that the decrease in economic output is going to be a result of governments attacking or continuing to attack your personal freedom and liberty by taking this authoritarian approach with more and more lockdowns, maybe even more draconian than what we saw in 2020. So what's the government's response going to be? Probably more and more deficit spending and stimmy checks. Probably 10 times, who knows, greater than what we saw before. So that results in another huge price spike like we saw in the middle of the 1940s. But let's think about this for a moment. This takes us to 2026, 2027-ish, let's say. And if you've read The Fourth Turning, or if you saw my interview with Neil Howe, he points out that between now and 2030, we are at the end of a fourth turning. Every single fourth turning that we have had in the United States has ended in war. And I asked Neil specifically, do you see another way out for this time frame, the next 8 years that we have from 2022 to 2030? And he just simply looked at me and he says, well, I don't know. All I can tell you is that every fourth turning that we have had in the past has ended in war. So for a moment, let's assume that we get that war that Neil Howe is referring to at the fourth turning. Well, that brings inflation way down. That's definitely lockdowns. Who knows what that does to supply? Who knows what that does to money printing? But that definitely decreases economic output and economic activity. So then at the end of the war, kind of the dust has settled, the phoenix comes up from the ashes, and then we start to have banks actually lending and creating more of those dollars through additional bank lending and extension of credit in the real economy, creating goods and services, which actually does create greater money supply, greater economic activity, and it produces consumer price inflation as a result not only of supply shocks, but now a result of actual economic growth, which takes us into that period very consistent with what we saw in the 1950s, that transition period, where interest rates go on that next multi-decade upcycle, where Jeff Snider and Lynn Alden would agree we are seeing inflation. So the main takeaways from this video, and remember, there are no certainties, there are only probabilities. But my base case is over the next 8 years, we will see prices continuing to go up. But at certain times, they'll go up at a faster or slower rate. Also, over the next 6 months or year, I think it's most likely these authoritarian governments implement more and more lockdowns, more and more restrictions that take away your personal freedom, liberty, and crush free market capitalism, decreasing the rate of economic output and economic activity. And lastly, I hope I'm wrong, but I think this exacerbates social unrest, civil unrest, and with the end of the fourth turning, this could result in war. The good news is usually something this catastrophic opens up people's eyes as to why freedom, liberty, and free market capitalism is so important. So in the decades to come, an economy and a global economy is built on a solid foundation, making a better future for your kids and your grandkids. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.